A country misses a payment. Not a rumor, not a downgrade, an actual payment. Somewhere in a quiet office in New York City or London, a wire transfer doesn't arrive. Screens refresh, nothing changes. And just like that, a sovereign nation, a government with an army, a flag, and millions of citizens, is officially in default. No explosions, no tanks, no dramatic speeches. Just a number that wasn't paid. And yet that single missed payment can wipe out savings, collapse banks, freeze pensions, and push millions into poverty. So what actually happens when a country defaults on its debt? Let's slow this down. Right now, governments around the world owe more money than at any point in modern history. Trillions upon trillions in sovereign bonds are circulating through pension funds, insurance companies, hedge funds, and central bank balance sheets. For decades, investors treated government debt as the safest asset in the system. Risk-free. That was the phrase. But history keeps interrupting that assumption. In 2001, Argentina defaulted on roughly $100 billion of debt. In 2012, Greece restructured more than 200 billion euros. In 1998, Russia shocked global markets with a sudden ruble collapse and default. Each time, the pattern was different, but the mechanism was similar. To understand what really happens, we need to understand what government debt actually is. When a country runs a deficit, spending more than it collects in taxes, it issues bonds. These are promises. Lend us money today, we'll pay you back later, with interest. Those bonds are bought by domestic banks, foreign governments, pension funds, and, sometimes, ordinary citizens. The government now has cash to fund schools, roads, military salaries, healthcare, or simply to roll over older debt. That last part matters. Most governments don't pay off their debt in the way households do. They refinance it. When a bond matures, they issue a new one to pay back the old one. It works as long as investors keep buying. Default begins quietly. Step 1. Stress. Maybe tax revenues fall during a recession, maybe interest rates rise sharply. Maybe the country borrowed in a foreign currency and its own currency weakens. Suddenly, debt payments become more expensive. Investors notice. Bond yields start rising. That's the market demanding higher interest to compensate for risk. Higher yields mean higher borrowing costs. Higher borrowing costs mean bigger deficits. Bigger deficits mean more borrowing. This is where the spiral begins. Step 2. Loss of confidence. If investors start believing the government might not repay in full, they stop buying new bonds, or they demand punishing interest rates. The government now faces an ugly choice. Cut spending dramatically, raise taxes aggressively, print money, or stop paying. Each option has consequences. Cut spending too fast and you deepen a recession. Raise taxes in a downturn, and you shrink growth further. Print money and you risk inflation or currency collapse. Eventually, math wins. The government announces it cannot meet its obligations as promised. That's default. But default doesn't mean the country disappears. It means the terms change. Sometimes payments are delayed. Sometimes interest rates are reduced. Sometimes investors are forced to accept less than they were owed, what's called a haircut. In Greece's case, private bondholders lost more than 50% of the value of their holdings. Now, here's where things get uncomfortable. When a country defaults, the immediate victims are not abstract markets. They are institutions that hold government bonds. Domestic banks, pension funds, insurance companies. If local banks hold large amounts of government debt, which they often do, a default can cripple the banking system. Banks rely on government bonds as safe collateral. If that collateral suddenly isn't safe, lending freezes. Businesses can't get loans. Households can't refinance mortgages. Credit cards tighten. The real economy feels it quickly. Currencies usually fall during default crises. Investors flee. Capital leaves the country. Imports become more expensive. Inflation often spikes, especially if the government resorts to printing money to cover spending gaps. In Argentina's 2001 crisis, bank accounts were frozen. Withdrawals were limited. Savings evaporated as the peso collapsed. Trust, once broken, is expensive to rebuild. And yet, here's the irony. Default is sometimes the beginning of recovery, because debt that cannot be paid will not be paid. Once restructured, a country's debt burden can become manageable again. Interest payments shrink, fiscal breathing room returns. After its painful restructuring, Greece eventually returned to bond markets. Argentina, despite repeated crises, continues to borrow again and again. Markets have short memories when yields are high enough. But let's zoom out further. There are two very different kinds of sovereign default. The first is default in your own currency. Countries like the United States, Japan, or the United Kingdom borrow primarily in currencies they control. In theory, they can always create more money to repay nominal debt. The risk there isn't technical default or currency debasement. The second, more dangerous, type is default in a foreign currency. If a country borrows heavily in dollars or euros, but earns revenue in its own weakening currency, it cannot print dollars to repay dollar debt. That mismatch has triggered countless emerging market crises. When the currency falls, the real burden of foreign debt explodes. Now layer in global finance. Large asset managers, sovereign wealth funds, and multinational banks hold emerging market debt across continents. A default in one country can trigger sell-offs elsewhere, as investors rush to reduce risk. This is contagion. In 1998, Russia's default didn't just hurt Russia, it nearly collapsed a major U.S. hedge fund and forced emergency coordination by the Federal Reserve. Sovereign default is not isolated. And then there's the political dimension. Austerity measures tied to restructuring agreements can lead to protests, government collapses, and social unrest. Public workers lose jobs. Subsidies are cut. Taxes rise. Citizens who never voted on bond issuance bear the consequences of repayment negotiations conducted behind closed doors. Which brings us to the uncomfortable incentive problem. Politicians operate on election cycles. Debt often stretches beyond them. Borrowing today funds visible benefits now. The costs are spread into the future. If a country offers slightly higher returns than a safer alternative, capital flows in, until it doesn't. Rating agencies downgrade only after risks are visible. No one individual causes a sovereign default. But the system quietly rewards short-term stability over long-term sustainability. And here's the deeper tension. Government bonds sit at the foundation of the global financial system. They are used as collateral for derivatives. They shape interest rates across the economy. We call them risk-free. They are not. They are politically backed promises. Most of the time, that's enough. But when growth slows, demographics shift, interest rates rise, or geopolitical shocks hit, the arithmetic tightens. Debt to GDP ratios climb. Interest payments consume larger portions of tax revenue. Refinancing windows narrow. And suddenly, markets ask a simple question. Can this country still pay? If the answer becomes uncertain, everything reprices. So what really happens when a country defaults? Bondholders lose money, banks weaken, currencies fall, inflation often rises, political systems strain, global markets wobble, and then, slowly, a new equilibrium forms. But the scar remains. Borrowing costs stay higher for years. Policy flexibility shrinks. Default is not the end of a country. It's a reset. A violent one. And as global debt levels continue to rise, interest rates remain volatile, and political systems grow more polarized, the question becomes less theoretical. Not could it happen, but where would the pressure show first? Because sovereign default is rarely about a single missed payment. It's about confidence, and confidence once questioned can unravel faster than anyone expects. So the next time you hear government bonds are the safest asset in the world, consider the quiet assumption underneath that statement. That growth will continue, that politics will cooperate, that investors will keep believing. And ask yourself, what happens if they don't?